Most traders don't blow up because of bad entries. They blow up because of this one silent mistake. You pick good setups, you study charts, and somehow your account still bleeds. Sound familiar? Here's the uncomfortable truth: your strategy might be fine. Your position sizing is probably not. The best traders in the world obsess over one simple rule most people completely ignore. Miss it, and one bad trade can erase weeks of progress. In the next few minutes, you'll learn the 81 rule for position sizing that protects your capital and keeps you in the game, and the tiny tweak that separates surviving traders from the ones who quietly disappear. Let me tell you something most men learn too late in this game. It isn't the market that ruins them. It isn't bad luck, and it surely isn't that the tape is against them. No, it is the size of their bet. That is where the real damage is done. I have seen traders call the market right and still lose their stake. I have watched men read the trend clean as a whistle, only to be wiped out by one careless position. Strange, isn't it? You can be right about direction and still end up broke. That puzzle has buried more hopeful operators than any bear market ever did. You see, the first rule of position sizing is very plain, though most fellows try hard to ignore it. Never risk enough on a single trade to wound your ability to continue. Simple words, hard discipline. Tell me, what good is being right tomorrow if today's trade knocks you out of the game? Most traders don't think in terms of survival. They think in terms of winning. That is their first mistake. The market is not impressed by your confidence. It does not reward boldness for its own sake. It rewards the man who can stay solvent long enough for his judgment to pay him. When I was younger on the street, I learned quickly that big losses come from big positions taken at the wrong time. Not because the idea was foolish. Sometimes the idea was sound. But because the size was reckless. Have you ever felt that sting? The market moves a little against you and suddenly the loss feels heavier than it should. That is not bad luck. That is poor sizing talking. A wise operator thinks first of how much he can afford to lose, not how much he hopes to make. That is the money mindset that separates the speculator from the gambler. The gambler asks, how much can I win? The trader asks, how much can I survive losing? Which question have you been asking yourself lately? Here is the quiet truth most chart readers overlook. Your edge only plays out over a series of trades. Not one trade, not two, a series. If your position is so large that one ordinary loss damages your capital or your confidence, you have already broken the first rule. I have always said the market is a device for transferring money from the impatient to the patient. But patience is impossible when your position is oversized. When the stake is too big, every tick feels personal. You start watching the price instead of reading the market. Ever notice how your judgment gets cloudy the moment the position feels too heavy? That is not coincidence. That is human nature under pressure. Proper position sizing keeps your head clear. It lets you sit tight when you should sit tight. It lets you admit you are wrong without feeling wounded. And believe me, the ability to admit you are wrong quickly is worth more than any clever chart pattern you will ever memorize. Now, I am not telling you to trade timidly. There is no money in fear, but there is wisdom in measured risk. The professional operator presses when he is right and retreats when he is wrong. But he always lives to make the next play. Do you see the difference? Many traders try to fix their results by hunting for better indicators, sharper entries, secret patterns. They spend years doing this. Meanwhile, the real leak in their account is the size of their positions. It is like trying to sail faster while there is a hole in the hull. Until the sizing is right, nothing else performs as it should. The Fei-1 rule, stated plainly in my own way, is this: risk only a small, predefined portion of your capital on any single idea. Small enough that a normal loss feels like a scratch, not a wound. Because trading is not about being right once. It is about being right often enough over time, while keeping your capital intact. You must think like a steward of your money, not a hero chasing glory. The market does not pay for courage alone. It pays for discipline repeated day after day. That is why the quiet, methodical traders often outlast the loud, confident ones. Consider this carefully. If you risk too much, even a sound system will fail you. But if your sizing is controlled, even an average system can grow steadily. That is the mathematics of survival. That is the arithmetic most men overlook while they dream about the big score. And there is another thing, something fewer people talk about. Oversized positions do not just damage your account, they damage your mind. After one or two heavy hits, the trader becomes hesitant second, guessing fearful at precisely the wrong moments. Have you ever noticed how one painful loss can haunt your next 5 trades? That is why the seasoned operator protects his capital first and his confidence second. Because without those two, no chart pattern in the world will save him. Position sizing, properly handled, gives you staying power. It gives you emotional control. It gives your edge room to breathe. And most important of all, it keeps you in the game long enough for experience, the real teacher, to work in your favor. Think in percentages of capital, not in dollars of profit. That simple shift in thinking separates the steady operator from the hopeful gambler. Most men come into the market with their eyes fixed on how many dollars they can make. They say to themselves, if this trade moves 2 points, I'll make 500, 1,000, 10,000. They build the whole decision around the prize. But the market has a way of punishing men who think that way. You see, the market does not care what you hope to make. It only responds to what you risk. When you think in dollars of profit, your position size quietly swells and shrinks based on emotion. When you think in percentages of capital, your risk stays disciplined and consistent. Tell me, which one do you suppose leads to long-term survival? I learned early that money in trading must be treated as working capital, not spending money. Each dollar in your account is a soldier in your army. If you send too many soldiers into one battle, you weaken your entire campaign. But when you risk only a fixed percentage, 1%, 2%, whatever your rule may be, you preserve your strength for the long march. Consider 2 traders with the same account. One thinks in profits. He loads up heavy because he sees a big opportunity. The other thinks in percentages. He risks only a small slice of his capital, no matter how confident he feels. Now ask yourself, when the unexpected happens, and it always does in this business, which trader still has ammunition left? The beauty of percentage thinking is that it adjusts automatically. When your account grows, your position size grows with it. When your account shrinks, your exposure contracts. It is self-correcting discipline. But the trader who thinks only in dollar profits rarely adjusts properly. He trades too large when he feels bold and too small when he feels afraid. His results become uneven because his sizing is ruled by emotion instead of arithmetic. Have you ever noticed how traders love to say, I'm only risking $100 on this trade? It sounds reasonable on the surface. But $100 to whom? To a $10,000 account? That is 1%. To a $2,000 account, it is 5%. Same dollars, very different risk. That is why thinking in fixed dollar amounts can quietly lead a man into trouble without him realizing it. Percentage thinking forces honesty. It forces you to respect your capital. It removes the illusion that a trade is small just because the dollar figure looks harmless. The market measures risk in proportion, not in comfort. There is also a psychological advantage that most fellows overlook. When you risk a consistent percentage, your losses feel uniform. They do not shock your nerves. They do not cloud your judgment. But when your sizing jumps around based on profit hopes, every loss feels different. Some sting lightly, others hit like a hammer. That inconsistency breeds hesitation, and hesitation is expensive. The professional operator understands that trading is a game of many plays. He does not need any single trade to make his fortune. He needs a method that keeps him solvent while his edge expresses itself over time. Percentage risk is the quiet machinery that makes that possible. And let me tell you something else. Confidence is often highest right before the market humbles a man. When traders think in dollar profits, their confidence tempts them to increase size at precisely the wrong moment. They feel certain. They feel clever. They feel due for a win. But the market has no memory of what you feel you deserve. By fixing risk as a percentage, you protect yourself from your own enthusiasm. You build a guardrail against your strongest impulses. That is not weakness. That is professionalism. Wealth in trading is not built by occasional large wins. It is built by steady compounding under controlled risk. Percentage thinking aligns perfectly with this principle. It turns trading from a series of emotional wagers into a structured financial process. Each trade becomes just one of many, properly sized, properly contained. Ask yourself honestly, are you planning trades around how much you hope to make, or around how much your capital can safely endure? That single question reveals more about a trader's future than any chart pattern ever could. One oversized trade can erase weeks of disciplined gains. That is not theory. That is the arithmetic of the market, and it has humbled more confident traders than bad analysis ever did. A man can do many things right. Study the charts, wait patiently, manage small losses, and still give it all back in one careless moment of excess size. You would be surprised how often this happens. A trader builds his account slowly, trade by trade, feeling proud of his progress. His confidence grows, his patience grows. Then one day he sees what looks like a perfect opportunity. Everything lines up, the pattern is clean, the story makes sense, and instead of applying the same measured risk he used before, he decides, just this once, to press harder. Have you ever told yourself that? Just this once. That is usually when the trouble begins. You see, the market does not punish you for being wrong. Being wrong is part of the business. The market punishes you for being wrong with size. A small mistake with small size is merely a lesson. The same mistake with large size becomes expensive tuition. The danger of the oversized trade is not always obvious at first. In fact, it often feels exciting. The larger position makes every tick seem more meaningful. The potential profit looks attractive. The trader feels engaged, alert, almost certain. But beneath that excitement is a simple mathematical truth. When position size expands beyond your normal risk, the margin for error collapses. Weeks of steady gains are usually built through consistency. Small, controlled risks, modest but repeatable wins. The curve of the account rises gradually, but a single oversized loss does not follow that same gentle slope. It drops like a stone. Tell me, how many careful steps forward does it take to recover from one large step back? Most traders do not fully appreciate the recovery math. Lose 10% of your capital, and the climb back is manageable. Lose 30 or 40% in one oversized trade, and the recovery becomes a steep hill. Lose half your capital, and now you must double what remains just to get back to even. The market becomes far less forgiving at that point. That is why the seasoned operator fears the big loss more than he desires the big win. There is also a psychological wound that follows an oversized hit. The account may recover in time, but the trader's confidence often does not. After a heavy loss, the next trade feels different. Doubt creeps in. Hesitation appears where decisiveness once lived. Have you ever noticed how one painful trade can echo through the next dozen decisions? This is why discipline must remain consistent even when conviction feels strong. The market has a peculiar habit of punishing traders most severely when they feel most certain. The moment you believe a trade cannot fail is often the moment you are most exposed to failure. The professional does not allow excitement to dictate size. He does not suddenly double or triple his risk because a setup looks beautiful. He understands that no single chart pattern, no matter how perfect it appears, deserves the power to damage weeks of steady work. Think of your account as a business, not a lottery ticket. A careful businessman does not risk a month's profits on one uncertain deal. He spreads his risk. He protects his operating capital. He knows that survival is what allows opportunity to compound over time. The oversized trader, on the other hand, is often chasing speed. He grows impatient with slow progress. He wants one strong trade to accelerate the process. But the market rarely rewards impatience. More often, it hands the impatient man a sharp reminder of why restraint matters. Consistency of position size is what builds smooth equity curves. Sudden expansions in size create jagged results, and jagged results are hard to sustain emotionally and financially. When the swings become too large, traders begin to interfere with their own systems. They exit too early. They hesitate too long. They lose the calm rhythm that steady trading requires. Ask yourself something plainly: if your next trade loses, Will it merely be a small setback, or will it undo weeks of effort? If the honest answer makes you uncomfortable, then the position is too large. The market will always offer another opportunity. Always. But it will not always forgive a trader who risks too much on one idea. That is why the wise operator treats every position with respect, no matter how promising it appears. Proper sizing keeps your judgment clear under pressure. That may sound like a small thing, but in this business the clarity of your judgment is your greatest asset. The charts do not trade themselves. Indicators do not pull the trigger. In the end, it is your mind, calm or clouded, that makes the decision. Most traders believe their biggest enemy is the market's unpredictability. I have found it is something closer to home. It is the distortion that creeps into a man's thinking when too much money is riding on a single position. Have you ever noticed how your analysis seems perfectly logical before you enter a trade, but becomes strangely flexible once the position starts moving against you? That is pressure at work. When your position size is appropriate, a normal fluctuation in price feels exactly what it should feel like, normal. You can watch the tape with detachment. You can read the chart instead of reacting to every tick. Your decisions remain grounded in observation rather than emotion. This is where clear judgment lies. But when the position is too large, something subtle begins to happen. The market stops being information and starts becoming threat. Every small move against you feels heavier than it should. You begin to hope instead of analyze. You begin to justify instead of evaluate. Sound familiar? Oversized risk turns intelligent traders into emotional ones. The first symptom is usually impatience. A trader with too much size will often exit winning trades too early because the open profit feels unusually large. The money starts to feel real, too real, and the operator grabs it quickly out of relief rather than following the chart. Have you ever taken profits early and later realized the trend was still healthy? That is often not poor analysis. That is oversized pressure. The second symptom is stubbornness on losing trades. When the position is heavy, the trader resists admitting he is wrong. He widens stops. He gives the market just a little more room. He watches losses grow while telling himself the setup is still valid. In truth, his judgment is no longer objective. It is defensive. Proper position sizing prevents this quiet shift in behavior. When the risk per trade is kept small and consistent, losses remain manageable. They do not attack the trader's ego or financial stability. Because of this, the professional can cut a losing trade quickly and cleanly. There is no emotional negotiation. The chart says the trade is wrong, and the trade is closed. Simple. Clarity thrives when fear is contained. Another thing worth understanding is that the human mind has limits under financial stress. When too much capital is exposed, the brain shifts into protection mode. It becomes reactive rather than analytical. This is not weakness. It is human wiring. The trader who ignores this fact is fighting both the market and his own biology. Have you ever found yourself staring at the screen, unable to decide whether to exit or hold? That frozen feeling is often the byproduct of too much size. The mind becomes overloaded because the stakes feel excessive. Good decisions rarely come from that state. The calm trader, the one whose size is properly measured, rarely experiences this paralysis. His risk is already defined. His loss is already acceptable. Because of this, he can think clearly in real time. He can respond to what the market is actually doing instead of what he fears it might do. There is also the matter of consistency. Trading success is not built on one brilliant decision. It is built on hundreds of ordinary decisions made correctly over time. Oversized positions disrupt this process because they introduce emotional spikes. One trade feels routine. The next feels critical. Judgment becomes uneven. But when position size is stable, decision-making becomes stable. The trader develops rhythm. He sees patterns more clearly. He trusts his process because the emotional noise is reduced. This is one of the quiet advantages professionals rarely talk about openly. You must remember that the market's primary weapon is uncertainty. It will never move in a perfectly straight line. There will always be noise, pullbacks, false starts. If your position size cannot tolerate normal market noise, your judgment will constantly be under strain, and strained judgment leads to costly mistakes. The goal is not to eliminate emotion. No trader can do that completely. The goal is to keep emotion at a level where it does not interfere with execution. Proper sizing is the lever that controls that pressure more than any mindset trick or motivational discipline. Survival in trading depends more on position size than on entry accuracy. That statement runs against what most newcomers believe, but the market has a way of teaching it with expensive clarity. A man may pride himself on sharp entries, precise timing, clever chart reading, and still find his account shrinking. Why? Because accuracy without proper sizing is like driving fast without brakes. I have known traders who could read the tape beautifully. They had a fine sense of trend. They could spot momentum early and often be right about direction, yet many of them never accumulated lasting wealth in the market. Strange, isn't it? Being right so often and still not getting ahead? The reason was rarely their analysis. It was the size of their positions. You see, entry accuracy gives you opportunity. Position sizing determines whether you survive long enough to benefit from that opportunity. If your sizing is reckless, even a strong edge will eventually be overwhelmed by one or two unavoidable losses. And losses, no matter how skilled you become, are part of this business. Let me ask you something plainly. Have you ever taken what looked like a perfect setup, only to watch it fail at the worst possible moment? Of course you have. Every trader who stays in the game long enough experiences it. The market does not reward perfection because perfection does not exist here. That is precisely why survival must come first. The trader who understands this stops obsessing over being right on every trade. He knows that even the best operators are wrong a fair portion of the time. Instead of trying to eliminate losses, an impossible task, he focuses on making sure no single loss can do serious damage. Most beginners do the opposite. They hunt endlessly for the perfect entry. They believe that if they can just improve their accuracy enough, the profits will take care of themselves. It sounds logical. It feels productive. But it quietly ignores the mathematics of drawdowns. Even with a solid strategy, a trader might be wrong 4 times out of 10. That is normal. That is healthy even. But if each of those losses is oversized, the account suffers far more than the winning trades can comfortably repair. Accuracy alone cannot fix poor risk structure. Think of it this way. 2 traders can have identical entry skill. One risks 2% per trade. The other risks 10% because he feels confident in his setup. Over time, which one do you suppose has the smoother equity curve? Which one sleeps better at night? The market rewards the man who stays powerfully average in his risk and patiently consistent in his execution. There is another misconception worth clearing away. Many traders believe that if they just improve their chart reading, they can safely trade larger. That is a dangerous assumption. Greater confidence often leads to greater exposure at precisely the moment uncertainty remains highest. The market does not become less uncertain because you feel more certain. Proper position sizing accepts uncertainty as permanent. It assumes that any trade, no matter how attractive, can fail. That mindset creates durability. It builds accounts slowly but sturdily. The trader who respects uncertainty lasts longer than the one who tries to outsmart it. Have you ever noticed how the biggest account damage often comes after a streak of correct calls? Confidence rises. Size increases. Discipline loosens just slightly. Then the market delivers an ordinary losing trade. Ordinary in analysis, but devastating in impact because the position was too large. That is the quiet trap. Survival-minded traders do not allow winning streaks to inflate their risk beyond reason. They understand that the next trade carries the same uncertainty as the last, no matter how well things have been going. This steadiness is what keeps their capital intact through the inevitable rough patches. You must also consider the compounding effect of staying in the game. Trading is not a single battle. It is a long campaign. Small, controlled risks allow your capital to participate in many opportunities. Oversized risks shorten your lifespan in the market, sometimes dramatically, and time, more than brilliance, is what allows edges to express themselves. The trader who survives 5 years with steady discipline often outperforms the brilliant but reckless operator who burns bright for 6 months and then disappears. Longevity creates opportunity. Opportunity creates growth. But longevity is impossible without controlled position size. So while most traders spend their energy trying to improve their entry by a few percentage points, the seasoned operator asks a different question. He asks whether his current position sizing allows him to withstand a normal string of losses without emotional or financial damage. Position size should reflect uncertainty, not confidence. That is a principle many traders nod at, but few truly practice when real money is on the line. You see, the natural instinct of most men in this business is to increase size when they feel certain and shrink size when they feel doubtful. It feels logical. It feels bold. It also quietly leads many accounts into unnecessary trouble. The market is a place where certainty is often an illusion. No matter how clean the chart looks, no matter how strong the story appears, uncertainty is always present. Always. The trader who forgets this is usually reminded in the most expensive way possible. When a man feels confident, he is tempted to press harder. He sees the setup he has been waiting for. The pattern looks textbook. The indicators align. Everything inside him says this trade should work, so he increases size. Just a little more, he tells himself. Have you ever done that? Of course. Nearly every trader has. But confidence is not the same thing as reduced risk. The market does not become safer because your conviction is higher. In fact, the trades that look the cleanest often attract the most participants, which can increase volatility at precisely the wrong moment. The seasoned operator understands this quiet truth. He does not let his position size swell simply because the setup looks attractive. Instead, he measures risk based on what the market can do, not what he hopes it will do. Uncertainty should always be the anchor. Think of it plainly. Before any trade plays out, there are only probabilities, never guarantees. Even the finest pattern can fail due to news, liquidity shifts, or simple market noise. When you size based on confidence, you are essentially betting that your judgment is stronger than uncertainty itself. That is a dangerous wager over the long run. Have you ever noticed how the trades you felt most certain about sometimes moved sharply against you, and the ones you were unsure about quietly worked? That is the market's way of reminding us that confidence is a feeling, not a risk measurement. Proper sizing respects the unknown. The professional trader approaches each position with a quiet humility. He assumes the market can surprise him. Because of this, his size remains controlled even when the setup looks excellent. This is not hesitation. It is calculated respect for uncertainty. There is also a psychological benefit that comes from sizing this way. When your risk is based on market structure rather than personal conviction, your emotions stay steadier. You are not riding a wave of excitement into the trade. You are executing a plan. The trader who sizes based on confidence often rides an emotional cycle. High conviction leads to large size. Large size creates pressure. Pressure clouds judgment. And once judgment is clouded, even good setups can be mishandled. But when size is anchored to uncertainty, the emotional swings flatten. Each trade carries similar weight. Wins feel controlled. Losses feel manageable. Decision-making becomes more consistent. Let me ask you something directly. When you increase your position size, is it because the risk in the market has truly decreased, or because your confidence has increased? Most traders, if they answer honestly, will admit it is the second. That is the habit that must be corrected. Uncertainty can be estimated through structure, through stop distance, volatility, and market behavior. These are objective measures. Confidence, on the other hand, is subjective. It rises and falls with recent wins, social sentiment, and personal bias. One is grounded in reality. The other is shaped by emotion. The great operators learn to trust the first and treat the second with caution. There is also the matter of longevity. Traders who size aggressively during moments of high conviction often experience uneven equity curves. A few large wins may feel impressive, but they are frequently followed by sharp drawdowns when the inevitable losing trade arrives with oversized exposure. Consistency in this business is rarely built on bursts of confidence. It is built on controlled participation through uncertain conditions. Remember, the market does not reward you for how strongly you believe. It rewards you for how well you manage risk when your belief turns out to be wrong. And it will turn out to be wrong from time to time. That much is guaranteed in speculation. The quiet professional knows that every trade, no matter how promising, carries unknown variables. Because of this, he sizes positions with respect for what he cannot see. He does not assume the market will behave simply because the setup looks clean.